GM, everybody, welcome to the daily digital download for Thursday, May 28th. How the heck are y'all doing today? I hope you're doing well. I have had a ton of meetings today, so we're a little bit later than normal. Thank you for bearing with me. Let me add the old link to the TL, and once again, I have misread the copy. All right. Boom. Posting it. We're live, baby. How the heck are y'all doing today? It feels so good to see that, doesn't it? Wearing my ETH Denver shirt. Always supporting. You know, I have love for Ethereum, even though we're in tough times right now. The Ethereum Foundation is having a bit of a soul-searching moment. If you look at all of the .ETHs on CT, man, they are turning on the EF quicker than ever. I think we just have to come to the grips with the fact that the Ethereum Foundation is not what it once was. It's not tasked with growing out the Ethereum ecosystem like it once had been. And fiscally speaking, financially speaking, it's not all that powerful as an entity. They have 0.13% of the total Ethereum supply. Yeah, that's a lot of money, but what's it really getting Ethereum? Shout out to B Smokes if you're watching this right now. You're traveling the world with your lady. You shouldn't be on CT. So yeah, let's just jump into the news. Speaking of Ethereum, VanEck has debuted its first BNB ETF. Man, I have pain with BNB. I remember listening to CZ talk on a podcast in 2017 about Binance and what his vision was for the Binance Smart Chain. And BNB back then was 25 cents. And I thought back then, like, this makes sense. I should get some. Never did. Still don't. And this is why I have to work for a living in crypto, because I never made the killer buys when they were cheap. But VBNB is the first, it's the first BNB-oriented ETF on the American stock exchanges. That being said, the whole reason why I wanted to highlight this news is that staking is not included in this ETF. And VanEck opted not to include staking because of lingering U.S. regulatory uncertainty. So the shares of VBNB are physically backed by BNB, held in cold storage with Anchorage Digital Bank. Here we go. This is a great quote. This is from VanEck senior investment analyst Patrick Bush, which he said in a release, quote, BNB has been one of the most resilient major cryptocurrencies through the recent market cycle, roughly flat over the past year, while most layer one peers experienced significant drawdowns. This is partly due to the fact that BNB is one of the most actively used blockchains in the world, processing over 14 million transactions per day and supporting more than 2.5 million daily active users. It also boasts a strong user base with ample resources, including more than $16 billion in stablecoin supply and $3.6 billion in RWAs. Shout out to the Binance Smart Chain. Moving on, Standard Chartered is comparing Ethereum today to Amazon in 2001 during the dot-com bubble burst. Standard Chartered has been getting into the crypto game this past year. And I think it's really interesting to talk about this article, even though I do have some concerns about the price valuation of ETH because, well, we'll get into it in a minute. During the tech bubble burst, Jeff Bezos said that the stock is not the company and that the company is not the stock. Even though he watched the stock price fall from $113 to $6, he was also watching all of their internal business metrics at Amazon and single thing about the business was getting better. And so while the price was going in the wrong direction, everything in the company was going in the right direction. And so that is kind of the metaphor that Standard Chartered is using for the price of Ethereum. Internal Ethereum metrics, such as locked TVL, measured in Ethereum terms, ETH terms, transaction numbers and TVL remain at all-time highs in ETH terms. Even though the price of ETH has fallen 57% from its August 2025 high, that doesn't matter. And so the crux of Standard Chartered's argument is that stronger metrics will eventually drive stronger ETH prices. And maybe this is them talking their book, but the analyst, what's his name? Jeffrey Kendrick has ETH targets of $4,000 by the end of this year and $40,000 by the end of 2030. His major bullish thesis is that Ethereum is continuing to dominate in stablecoins and RWAs. The stablecoin market cap is expected to be around $2 to $3 trillion by 2030. Kendrick is stating that he believes it to be around $2 trillion by the end of 2028. That being said, I will note that the stablecoin market cap has not moved very much this entire year. It's roughly been hovering around 300 billion, give or take 10 billion or so. His thesis, this Kendrick fella, is that the stablecoin market cap will push more activity into the Ethereum ecosystem and will therefore drive ETH prices higher. He also noted that non-stablecoin RWAs could grow by 50 times, up to $2 trillion by the end of 2028. So, while I have historically ascribed to the thesis that more RWA capital, more non-native capital coming on-chain is good for the longevity of a blockchain, I still am at odds with how we see the price of the native token on that blockchain rise. Because Ethereum has the majority of RWAs and the majority of stablecoins, and yet its token price is not doing well. So my gripe with Kendrick's thesis is that on-chain capital and activity does not equate to price and price action. Another thing that the author pointed out is that the upcoming launch of the Ethereum Economic Zone, which is designed to allow assets to move more freely across the Ethereum ecosystem and improve composability between protocols, could reduce reliance on bridges, which typically leads to hacks. This was also my thesis for a long time. If you build bridges and ways for people to come into the ecosystem, they will. But that never played out either. Because if there's opportunity in an ecosystem and it's difficult to get there, people will figure out a way to get there if they want to. So just because you build a bridge for somebody to land there, and just because you capture capital in terms of RWAs or in terms of stablecoins, that does not mean that more users will come to your chain or that the price will appreciate with more capital allocated on your chain. So, I'm a bit of a Schrodinger's cat with this article. While it's amazing to see Standard Chartered saying all these things, I've been saying them since October 2023, and still have not been proven right that more capital coming on chain will increase the price of the underlying asset on that chain, the native asset, and that building bridges will increase users. That being said, maybe I'm wrong. Maybe I was just using experiences from the ecosystem that I was working within as my North Star. And maybe Neo just wasn't poised to capture users. And maybe I just wasn't put into a position to watch firsthand from a front row seat what building bridges would do for an ecosystem. I don't know, man. this is actually something that I'm going to have to be thinking about and looking at in the mirror, because for many years I was saying if you bring external capital onto a chain, that would mean that chain will survive and thrive. Really, maybe how my thesis is changing, I think now, is that if you have capital on chain, that just gives your chain a reason to exist. That doesn't necessarily give it an economic reason to increase in price and value. So I really need to go back to the drawing board and re-examine my thesis, because we're 2.5 years into the first time I told Neo leadership that they needed to build for stablecoins and RWAs. And yes, we've seen the market cap for both of those asset classes go up. But as we can see with Ethereum, it didn't necessarily drive the underlying price of the ETH asset up. In fact, ETH is down over the past year. Anyways, I just wanted to point out this article, and this is going to be really good for me to look back on, especially as my agents help me with creating transcripts and help create a corpus for tracking and monitoring how crypto has grown over the years. Into crime season. A Google engineer has been charged by the U.S. with using Google's internal search data to pocket $1.2 million from profitable trades on prediction markets. Michelle Spagnuolo, a software engineer at Google, has been charged with fraud and money laundering after making $1.2 million in profits using insider information on Google-related trades on Polymarket. Between October and December of 2025, Spagnuolo allegedly used an account known as Alpha Raccoon to place trades on Polymarket, where he participated in at least 23 contracts tied to the platform's the 2025 year in search list, including markets as the #1 searched person on Google this year and the top 5 most searched people on Google in 2025. Good man, you were using information that only insiders would have to make a bunch of money. I'm glad you got caught. Spagnuolo is a 36-year-old Italian citizen residing in Switzerland who was arrested in New York last week and faces charges on commodities fraud, wire fraud, and money laundering, which carry maximum prison sentences of 20 years, 10 years, and 20 years. Yikes. The CFTC is seeking civil monetary penalties, restitution, and trading bans against Spagnuolo. Crime season, but hey, look. At least it wasn't an AI agent destroying a DeFi protocol today. I'll take it. In other news, Cash App, the app launched by former Twitter founder Jack Dorsey, has integrated support for sending USDC stablecoins on chains like Solana, Ethereum, Polygon, and Arbitrum. Cash App users can now send USDC on those 4 networks and receive them on multiple blockchains. Cash App currently has 59 million monthly active customers. And this is a notable story because Dorsey is a Bitcoin maxi. He also fired 40% of the block's staff earlier this year, citing that AI can make things better. But the majority of features that have been implemented into Cash App are usually related to Bitcoin and Bitcoin tooling. So, to see a company led by a Bitcoin maximalist integrate support for stablecoins on multiple blockchains, I think is just a canary in the coal mine saying that stablecoins are here, they're going to continue to be growing, and even if a Bitcoin maxi adds support for stablecoins on 4 different smart contract blockchain networks, that's a signal. That's a signal that we're here, that we are finding product market fit as a asset class, as a technology. And when one of the most staunch Bitcoin maxis is integrating support for this, there's a there. The mobile payments companies upgrade comes as banks, fintechs, and payment companies invest in or explore stablecoins. Major payment networks such as Visa and MasterCard are also both expanding into stablecoins. Yeah. Look, stablecoins are and have continued to be the killer use case for blockchain and crypto for many, many years now. So don't fight the tide, I think is the story here. On to our second to last piece of news. I started talking about this earlier when I was doing my first round of daily digital downloads in February of this year, when a lot of Bitcoin miners were announcing that they are pivoting from their Bitcoin mining operations to providing infrastructure services for AI. And so now there are several Bitcoin mining converted to AI operations that are doing really well right now. So legacy Bitcoin miners that pivoted to AI, hyperscale computing, and other data center infrastructure are continuing to be rewarded. Yeah, I mean, these are using your GPUs for AI, for data services, are businesses that investors themselves are now seeing to be more attractive than traditional mining operations. So not only are miners earning better revenue that is outside of a hyper-speculative cryptocurrency, but also investors are buying the stonks of these companies. And of course, they're all down today. But anyways, Iron, Cipher Digital, and Hut 8, TerraWolf, and Riot Platforms are all starting to see increases in their token price, their stock price as they pivoted to AI. And yeah, I mean, this, not only are we seeing infrastructure service providers pivot from blockchain to AI, but we're seeing builders in blockchain leave blockchain and go to AI. Intern yesterday or the day before just announced that he's going to work for a robotics company. So we're just in the depths of the bear market where we're continuing to see brain drain to other innovative tech sectors. We're continuing to see negative sentiment on CT. I mean, like when .eths are piling on the Ethereum Foundation, when you have internal communities fighting amongst one another, that is just a fresh signal that we're in a negative time. David Hoffman from Bankless sold all of his ETH. Look, I'm not going to knock him on that. I get what it's like to have to sell assets in an ecosystem you believe in. But all of these things are pointing to the fact that we're closer to pain of the bear market than we are further away from it. And this is my third crypto bear market, working in the industry full time. And the one thing I've learned in bear markets is you want the absolute bottom of pain to come as quick as possible, because once you have nothing left to lose, there's nowhere to go but up. And so personally speaking, I want to see more capitulation from OG holders. I want to see infighting reach absolute maximum highs. I want to see the most amount of crypto builders and companies leave to go work in other verticals. Because once we've lost all of those people, only then can we start building for something newer, bigger, and better. And if you look at the killer crypto use cases and killer blockchain projects that are used today, the vast majority of them were built during the 2018 and 2019 bear market and the 2022-2023 bear market. So if you're watching this now, if you're building in blockchain and crypto now, keep your head down, keep reading, keep learning. I'm not going to say keep watching me. I don't know, man. I'm just another guy who's been surviving in crypto since 2018. I still have to work for a living. So like, I'm not a millionaire. I haven't made it. Like, what do I know? I've just survived 8 years. But if you're still here learning and you're interested in building, go after it, man. Go do it. Or girl, fella, person. Because it is the people who are sticking around today and are building today and are looking forward today, those are going to be the people who are really happy with the decisions they're making today in 1 to 4 years. So I'll just leave it at that. My final piece of news for the day is for Americans. Woohoo! And not just Americans, but central custodial exchange users. The complete antithesis of what we are as cypherpunks and people who love blockchain and cryptocurrencies. But Kraken has expanded its Earn program to offer yield on Bitcoin. Anybody who remembers Celsius and BlockFi is probably shivering a little bit on the inside. And anybody who remembers Gemini's Earn program is probably shivering a little bit on the inside. Whenever I hear centralized custodial entity adding Bitcoin rewards, I start to get worried because I have flashbacks, like I'm a Vietnam veteran. I have flashbacks to 2022 and 2023 when Celsius, BlockFi, and Gemini Earn all collapsed as a result of the Three Arrow Capital contagion. But that being said, you can earn up to 2.5% in rewards on your Bitcoin by putting it in Kraken Earn. And that way you don't have to wrap your Bitcoin and put them onto DeFi protocols or move funds off of the regulated exchange. The Bitcoin Vault is powered by DeFi infrastructure provider Veda and allocates funds across on-chain lending protocols like Aave, Morpho, and Tidro, where users borrow assets and pay interest back to depositors as yield. So you don't have to put your Bitcoin onto Aave, Morpho, or Tidro, but Earn will. So DYOR, do your own research before you send your hard-earned, hard-fought-for Bitcoin. Before you put it on a custodial exchange and before you start earning yield, go look into where you're earning yield and how Kraken is earning yield on your behalf. If there's anything I learned from the collapse of Celsius and BlockFi and the legal problems that the Winklevi had subsequently from Gemini Earn, is to just understand how those assets are earning funds, where and how they get locked up, and how your funds are separated from you in case there's a legal battle. That being said, look, I am happy to see a federally regulated exchange here in the US offer more services. I think that as a crypto native who wants non-crypto natives to use our assets and our technology, something like Kraken is probably the happy medium to onboard my dad or my skeptical cousin or my friend who has an extra $100 here or there lying around that they want to put into crypto. I would like to send them to Kraken, to Gemini, to Coinbase first before teaching them about Ledger and Trezor and DeFi and managing your funds on chain and not your keys, not your coin. So while I personally am not super geeked about Earn and earning 2.5% on my Bitcoin via Kraken, I am excited for the opportunities that this opens up to expand our market for people who invest in or hodl cryptocurrencies. And so, folks, today was a short one, 5 minutes shorter than normal. If you haven't yet, please subscribe to our weekly newsletter at thesmarteconomist.beehive.com. I really need to get back to posting these more regularly. I'm trying to figure out what the best way to do these is. At first, I was trying to interject my voice in my narrative, but I think I'm going to change the format for the Smart Economist for the next couple weeks to be more of an aggregator, to offer one-lines about what we spoke about during the daily digital downloads, and then use that as a seed for you to invest into your own knowledge. If you read something, and I want you to be able to read what we spoke about all week within 3 to 5 minutes, and if you find something of interest, then I don't want you learning about it from me and my take. I wanted to open the door for you to go do your own research. So I'm going to be tweaking how we deliver these weekly newsletters, and we'll see if more of a listicle kind of makes sense moving forward. But anyways, with all that said, thank you to King Ragnamix and to B-Smokes for liking the post for today's Daily Digital Download. Thank you to all of you who are watching this right now. And I'll catch you guys tomorrow. I'm looking forward to the space we're having tomorrow on the Smart Economy podcast. I'm going to be talking about agentic payments with a builder who just created a wrapped token standard that uses EIP and ERC composability to build on the foundation of ERC20 tokens so that agents can do agent-to-agent payments. It's going to be a really fun space. Go to the Smart Economy Podcast Twitter account to catch out that space. We will be live tomorrow morning at 11 a.m. EST. And with all that said, have a beautiful and safe and happy Thursday. I will catch you all tomorrow. Peace out. Take care of yourself.